Okay, welcome everyone. Here we are with the Smart Investing on the Financial Fox channel. So we have Clem, Zach is joining. Today is very exciting because we are going to be speaking about, the big problem of the moment, which is inflation. So we need
problem. Why is it a problem?
Well, I think because it's kind of panicking people. What should they do? Where should they invest? They're looking at gold and then crypto is going up. And I think it's like, it's like a point where people have to make a decision. And this is where experts like you, Clem, and, Zach is coming in, bringing his views. That's what people want to know. Where do they put their money?
Well, it's interesting because, where is the smart money? And the answer is one of the places the smart money goes is auctions like Sotheby's and Christie's. And if you look at what's going on there, some things are absolutely going ballistic. And of course, alternative investments are an area that is always good for hedging against inflation. So some of the smart money is buying anything that's not nailed down. That's a physical asset. And you can see that going on in auctions. So that's one way. Another way is to get short of money. I mean, that might sound weird to some people. Get short of money. What does that mean? I'm always short of money, they might say. I mean, to have negative money. Because if the value of money is going to go up and you've got negative money, you're going to make. Okay, sorry, if the value of money goes down and you're short money, you're going to make a profit in the same way as if you're short of stock and it goes down. Now, how do you get short money?
Yeah.
Well, you borrow it. And most people don't see their thumping great mortgage as being short cash. But that's exactly what it is. And of course, in 10 years' time, they look at the house and they go, oh, look, how much money I made from buying a house. Well, actually, they made a lot of money by being short of money because the value of money has gone down. Property values in real terms tend to go up because the population goes up, don't tend to go down in real terms. So if your value of your money goes down, the number on the for sale sign goes up. And that's not the telephone number, although it might look like one soon. Okay. So getting short of money is one way of doing it. Most people are very unhappy to get short of money because they want to pay off their mortgage. They don't want to get a bigger one. But in the short term, if you imagine that the value of money is going to halve, i.e. we're going to get inflation of 100%, then the numerical number of the value of the house is going to go up 2 times. So if the average house is now worth 300,000 or whatever the number is, it will be 600,000. Now the house will be worth no more cabbages or no more holidays or no more cars, but actually the numerical value will go up. So you would save your savings, or if you just borrowed money, you will make money on the fact that your debt just went down. So if your liabilities go down and your assets go up, you've made a profit. So, the old-fashioned mortgage is in fact being short money. So if people have got the wherewithal and feel secure in their employment, now might be the time to think about getting a bigger house or getting that holiday home or whatever it is that getting that extra buy-to-let or whatever their happy place is. Because if the value of money halves, the nominal value of those assets will double. I mean, maybe not. Maybe there'll be a recession, so maybe they're only got 50%. But being short money is one idea that people should think about.
Yeah, but isn't it the case that Clem, that you've got interest rates go up and then you can't afford your mortgage on your debt?
Well, I mean, there's a trouble in the UK that it's got this stupid mortgage system where everyone has to renew their mortgage every 2 or 3 years and all that insanity. But in other countries and other places, and maybe, I don't follow the UK property market in terms of how you get a mortgage, but, get a fixed rate for a long term. And then you don't have to worry about it. I mean, I love fixed rate mortgages. I mean, in Europe, you can get one for the whole period of your mortgage. So you can go in and they say, oh yeah, we'll charge you an extra 1/3% for a fixed rate for 30 years. I mean, for me, child of the 70s, I go, oh yes, please, I'll have 2. But the insanity of saying, oh yes, have a 3-year mortgage and then roll it with us in 3 years' time that you have to go through in the UK. As a child of the 70s, that seems insanely dangerous to me. But Well, I'm not a big fan of property myself, but you know, it's the key to more billionaires' fortunes than any other asset class.
It is the same in Italy as well, where you can do a 25 years mortgage at a fixed rate. That's
yeah, I mean, you know, that's the way to go.
yeah, okay. So good time to buy a second home or a holiday house. That's
Well, if you're secure
yeah.
in your income, obviously. If you're not secure in your income, that's really, you know, quite a dangerous thing.
Yeah. Okay, so we cover the property. What else investors can do? Because somebody maybe doesn't like to buy a house. They want to rent, they want to go on a holiday, whatever they want. They don't want a burden because it's still like something to look after, to rent,
well,
but you know.
Finance is a burden. You can't get around that. There's no easy fix. There's no get rich quick. You know, it's patient money that makes the money. It's strategic behavior that makes people wealth, not tactical, not oh, this is going to go up tomorrow. You know, the investors fly in private jets and traders tend to wear orange jumpsuits in American jails. So, you know, the trading route is very, very difficult. And also, even when you're successful, pretty unsustainable psychologically. Whereas investing is, you know, it's a grind, it's boring, getting rich slow is not terribly interesting to many people, but that's the way to do it if you want to do it. So you have to look to the medium term, at least the medium term, and to the long term. Well, you know, there's all sorts of waves that come about in inflation. One thing that I spotted recently, which I was very happy to spot because I've been going, why is gold going up? Is that gold, for example, doesn't go up in a straight line. It goes up, it can drift off, it can go up, it can drift off. And if you look at the gold price during the 70s, which had absolute runaway inflation, desperate economic times, gold did not go up in a straight line. It didn't go bang and stay up. It just went zag, 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 zag. And a couple of years actually went down, even during the worst part of inflation. But, you know, it's a strategic long-term thing and the market rights itself over the long term. So, you know, the things, gold is precious metals is one thing, not necessarily day-to-day reliable, but long-term reliable. Equities which have got pricing power are also good. So things like, you know, BT, for example, which seems to have suddenly gone now that inflation is
what is pricing power? Just explain that.
Well, imagine that I'm in a business and I sell ball bearings and I've got inflationary pressures. And I go to my customers and say, you're going to have to pay 7% more for my ball bearings. And they go, no, I'm going to buy it from India now. Yeah. Or no, I'm going to buy it from China. That's not pricing power.
Gotcha.
But if I'm if I'm maybe Centrica, probably I've got other problems with pricing with political problems. But if I'm in a business where I can just go, oh, by the way, you're paying 8% more. And then people have to go, oh, no, oh, okay, then, oh, can't get out of that. Then that's pricing power because those companies can go, tough luck, boys and girls, you're going to pay more because there's inflation and everyone has to go, yes, sir. And sometimes if you've got pricing power, inflation enables you to put up your prices much more than you would have normally because everybody's getting used to prices going up. So you go, oh, hold on a minute. I can rather than go from 70 to 82p, I go from 70 to £1 because nobody will notice the difference. So that's pricing power.
What about Tesco, for example, a food company where people still have to buy food? So perhaps this will be good for them.
I'm not sure. Zach might have a view on this, on the impact on people like supermarkets. I mean, what supermarkets make money out of is often well below what you see on the shelves because they've got sophisticated business models that they make money out of things which you wouldn't necessarily think they're making money out of, like how much cash they've got in the bank, which used to be a big thing for supermarkets because interest rates were high. Now is not a big thing, might even be a negative. So, you know, their discount structure, their rebates, people paying for being at the front of the shelf rather than the back of the supermarket, stuff like that. There's all property and blah, 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 blah. So I'm no expert. What about that, Zach? And pricing power for supermarkets? I think he's.
In my freeze. Well, that's interesting. So basically, their main assets will be debt.
Yeah, debt's normally called a liability, but you know, other people's. As I said, I'm no expert on supermarkets. But supermarkets have been very poorly valued for quite a long time during inflationary periods. Okay. So, maybe they will be good. But the other thing to think about is that what is the mechanism that governments inject stimulus into economies? And the answer is they inject money into the system in a way that pushes up the value of hard assets like real estate and like equities. And then that wealth effect filters down into the broader market. And that's why in the past, all these liquidity operations, the QEs that we've been experiencing, hasn't generated much in the way of inflation, because it's gone into illiquid assets and then had a trickle down effect. What has happened is money has been injected in all levels of the financial system or the economic system. And if you want to create inflation, it's a very simple way of doing it. You hand out money to the poor because they've got to spend it. They're absolutely got to spend it. And not only have they got to spend it, they want to spend it. They enjoy spending much more than rich people who've got so much money, they just stack it up. They just stack their money, got nothing to spend it on. So they just save. Whereas, the poor or the less well off want things they can't afford. And you give them money, they buy them. And so what's happened with, particularly in America, they just handed out money to the underprivileged and to everybody, in fact. And that has been one of the reasons that we've got inflation, because you hand out money to people that want to spend. Now, if you hand out money to people that don't really need to spend anymore, don't want to spend anymore, have got enough, well, they just stack it up in the banking system, and then you get that trickle down. The moment you throw it out to everybody, boom, you get a boom in demand.
Clem, what's what? I mean, they've got the helicopter. Did the helicopter money thing, which was the thing they always try and avoid doing. They either reduce taxes or reduce interest rates, or try and do infrastructure spending, something like that. Hasn't this actually been a really good thing? The thing that the governments would never wanted to do?
Well, I don't know what you mean by good or bad in this instance.
Well, good. I mean, good. We got through it. It was great for the stock market. It's been great for, let's say,
the helicopter money is not. Yeah, the helicopter money doesn't drive the stock market. Yeah, that's liquidity drives the stock market. Helicopter money drives inflation, because you drop it on everybody, and a large proportion of the economic pyramid wants to spend that money immediately, and you generate a demand-led boom. And as there's no more output, you generate inflation. And, inflation's a good thing up to a level. Deflation's a bad thing over a certain amount of range. So a little bit of inflation is a good thing. And we're getting a little bit more than a little bit. Now, it's going to carry on, though. And people need to be ready to have any savings they have, cash savings, so seriously nibbled away at. And, people that have got fixed incomes, people that have done their savings through pensions, done their savings and got cash in the bank, they're going to get clobbered. So, that's the downside of inflation. And we're there because as you said, it's a good thing that the governments have bridged the economic chasm of the COVID lockdowns. But the price for that is going to be come through as inflation, because the loss of wealth caused by that period, which is probably about 10%, is got to be, there's a price for that. And that price is going to be paid through inflation. So the question is, how does the individual minimize that impact? And for some people, they won't be thinking about minimizing it, or they can't minimize it, or they'll just be stuck there with no way of getting around it. They're going to take a pretty serious haircut. And if you're smart enough to be able to dodge the bullet, and maybe even make from that economic environment, then you'll be sat pretty.
So basically, okay, we need to get out of cash, look for opportunity, like perhaps get a mortgage, buy a second home, look for assets.
Or get a mortgage if you haven't got one.
Yeah, exactly. And then look for company with price power. So what about some consumers company?
Well, I think the key thing to realize about inflation is that it clobbers the economically passive. And it actually helps the economically active.
Yeah.
I mean, if you get in a situation of hyperinflation, like they had in Germany, for example, some people are having a whale of a time. Yeah, because you can throw your money out the window, you can live it up, you can go wild, because there's only going to be more money being coming off the printing presses tomorrow. But if you're economically passive, you're a pensioner, and you're too old to work. Maybe you don't have the wherewithal to do anything to earn or leverage up what you have. Well, you get wiped out. So the important thing is to realize that in the coming period, it's quite important to be economically active, as opposed to, I want to retire when I'm 40 and all that stuff, which is economically passivity. That the economically passive are going to take a beating. Whereas the economically active, the more economically active you are, the more wild financial inflationary times are, the better it is for you. So, it's not all bad news. It just depends on which camp you are. There's always a party going on. The question is, you're not invited, and you need to know where it is. And that's what these sort of shows are about, knowing where the good news is and where the bad news is, so you can avoid the bad news and be in the good news.
So if we want to be more active, let's carry on with the company with price power. Do you have any other areas where perhaps we can see these dynamics, and then we can talk about gold?
Well, it's going to be, and I'm sure Zach will agree, it's going to be difficult times. Yeah, because the fundamentals are, you've had this loss of wealth, you've had this loss of economic momentum, you've had this disruption. And for that to repair, it's going to take a sort of a post-war period, a post-COVID period, and it isn't going to be easy. So, there's no, oh well, all you got to do is this, and it's fine. We're on this wonderful, happy pathway of good news. We're going to go through a bumpy period of repair. So, that repair is going to be aided by inflation, because that enables the money to slosh about, enables people to borrow money cheaply and see the liability that it has diminish. That facilitates the repair, and you'll see inflationary periods come after wars time and time again, and it's not accidental. In Britain in 1920, they cut the value of money in half at a stroke, because they took half the silver out of the coins and said, now it's only half silver. So in a stroke, there was what amounted to 100% inflation in a day. Did the same in 1947. They said, by the way, this half silver in our coinage, it's all gone now. Now it's nickel and copper. Sorry about that. And the franc went from, one little copper coin to 100 francs, the same little copper coin, because it was a post-war inflationary fix to the economic situation that all those countries are in. That's how you get out of economic trouble. You inflate the problem away over a period of a decade or so. Oh, and in fact, it was 2 decades, maybe even 3 decades in Europe. That is what we're going into now, probably a minor version of that. So it's a matter of, well, if you hold that, those silver coins, suddenly they take the silver coins away and give you non-silver coins. So you just lost all that value. Yeah. And that's the sort of thing that you have to try to avoid in those times. I tell you, if you went and bought numismatic coins in 1947, by 1972, they'd gone up 200 times. 200 times.
Wow.
Yeah. So that's the sort of thinking that people have to do, and they have to do it for themselves, because there's going to be no recipe for it. People will have to navigate with their wherewithal to dodge basically the bad news. And if they can find the good news, that's great. Equities will be, have intrinsic value, and therefore should be buoyed up, if not necessarily totally, by more and more liquidity, more and more money by devaluation. So that will be one place to hide. Precious metals will be another place to hide. Property has always been a place to hide. And then you've really got to get busy, because if you've got a pot of money, that value is just going to go down, 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 down. If you are getting a salary or a wage, that wage is going to go up and up and up and up and up and up. That's how inflation.
Clem, isn't crypto the place to hide? I mean, literally the best place to hide.
I think it's a really bad inflation hedge, because it's not what crypto does. Crypto
It
goes
was
through
rising.
the roof.
It was rising before inflation came, and
Yeah,
it's now
it went
rising
through,
even faster.
yeah, it just either goes to the moon or goes through the floor. I mean, it's not going up. I mean, there will be an element. I mean, and people apparently seem to think that a asset like Bitcoin, which can go from 60,000 to 30,000 to 60,000 in 9 months, is somehow a good hedge against anything. How can that be a hedge against anything? You'd want to hedge against its movements, not the other way around. But nonetheless, that people seem to think that somehow asset that can halve and double twice in a year is a good place to hide away from 5% inflation, which to me is a little bit insane. But crypto is a great place to look for capital gain, for sure. Is a great investment if you know what you're doing, for sure. Hedge against inflation, I suppose any good investment is a good hedge against inflation, but it's really not a safe place. It's like going to Jamestown in the gold rush. Yeah, you can get rich. Yeah, it's probably a good place to not have to worry about inflation, but it's probably not a good place to have to avoid about being stuck up by bandits. So I wouldn't advise anybody who wanted to have an easy and quiet life to go that route. In the same way as probably properties, the classic way to go, that people are quite happy to take high risks and quite happy to do quite a lot of work to actually own property. So it's for people's investment psychology, I think, is really the first place to start at.
Okay, what about gold?
Well, gold. I mean, come on, Zach, you tell me how gold is rubbish. Come on, please. You see, comes in.
No, I can. No, it's rubbish because it's been superseded. It was a good idea for since the dawn of time, but unfortunately in 2010 it became obsolete.
Well, I think that's a interesting idea.
And it was already becoming obsolete even before the GFC, because the QE should have been the thing. QE from 2008 should have got it through the roof, and it failed. And caught out people, clever people, very badly.
Well, I think if you look, I think you have to look at gold long term. And if you look at back in 2000, when it was trading at, it's something ridiculous, like $300 an ounce or something. Somebody at the time said, "Oh, so what's your prediction of gold?" I said, $1,000, no brainer. And they all looked at me like I was off, $1,000, you got to be kidding me. But it's not $300 or $400 now, or $250 or wherever it was. It's now $1,800. Now that doesn't seem like much for 20 years, but if you'd put a few thousand in there at 250, you'd be feeling pretty smart now. If you put it in Apple, you'd be buying a yacht. So that's the playoff. But I can see gold relatively quickly. I mean, I don't mean days or weeks or even short months, but certainly in a year or two over $3,000, or getting towards 4,000 even. But that's no big shakes when a Bitcoin can go from 2,000 to 60. So it's quite it is quite a hedge. It is dull. And if you want to spice it up, of course, you then go and you look at gold miners, and then you can get all the spice you want there. And, you can go to the boring gold miners and get some, good fun. And you can go to the slightly less boring ones and start to, feel the burn. And then you can go to the crazy speculative ones and, go wild. As I think I said, maybe on this show, when I was a child.
Oh, that's
one of my clocks. One of my clocks that isn't telling the right time, but then it didn't tell the time at all when I fixed it. But anyway, there was a gold mine called Metromar Minerals. It's the first stock I bought when I was 7 years old. And I got a press release that the same gold mining claim was being turned into an Australian listed company 50 years later. And I emailed the CEO and said, "Oi, you got to be kidding me. This was going to be a great gold mine 50 years ago. What are you doing?" It turned out it was a good gold mine, and now they're going over the tailings. But anyway, spicy speculative gold mines, for the people that want to trade, that's also an opportunity.
Clem, I've got 2 companies that I would like to discuss with you. One is Resolute Mining, which is a mining company in the gold space. So I want you to comment on that. And also JMAT, which today announced their exit exiting the battery metal business, and there is a new CEO. So we can go into that. I remember that you mentioned that company a while ago, so it's been hit quite badly. I mean, we see.
Right. Well, first of all, I've got one.
Ooh. Ooh. Okay, seems Clem is freezing.
I have a ton of gold mines, and they've been slapping me about the place because the world seems to think that inflation, up until like yesterday, isn't going to be a thing. You know, last year they were saying, oh no, it's going to be deflation. And I thought, what planet are you on? You know, because you should tell Elon Musk he'll come and visit you. But so you can see, and our JMAT, again, my only comment is I bought that this morning. And I think that what they've done is absolutely lamentable. Absolutely lamentable. I mean, it feels like to me, they've said, I'm looking at it now because this is one of my specialties, is to buy falling knives and try to clip 4 or 5% on when they do this sort of thing. And I was a bit early. I should probably buy it at 4:15 this evening, but I looked at the chart and I thought, I'll have some of that. But anyway, I used to love JMAT. And maybe I will love them again because they've got so much IP in green environmental technology based on precious metals that they should be worth an absolute ton. And they are valued like the world's worst company. I mean, they're valued at a fraction of their sales. I think 25% of sales, something ridiculous like that. If they were in America, they'd be worth trillions and trillions and zillions, and they'd have some young genius walking around saying how he's going to save the world. But being that it's a boring English company run by boring English people, no doubt, you know, they're paying a 3% dividend, which is nice. But, you know, if you scroll down and have a look at their sales, keep going, 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 stop, up a bit, just a bit more up, stop. Right. So they sell 15 billion pounds worth of technology and they're valued at 4 billion. I mean, in America, they'd be valued at somewhere between 4 and 10 times their sales. Yeah. So they'd be valued at 60 to 150 billion in America. And here they're at 4 billion. And that is the sorry, sad state of the British stock market. And I think they're a very interesting takeover opportunity for anybody with any sort of oomph, particularly in America. I mean, if I was an American company, I would put my hand down the back of my sofa and I'd go buy them. And, you know, it's lamentable. They basically said, oh, battery technology. Oh, yes, it's the future and all that. But no, we can't compete. You can't compete. Oh, really? Oh, no, the capital cost of it is too much. You mean you can't get your hands on any money in the current free money environment at 0%? So the cost of capital will be too much. And look at their balance sheet. They've got shareholders' equities up to their ears, as opposed to lots of companies out there which would have vast intangibles and much less shareholder equity, which translated into English means it's not a particularly leveraged company. In fact, it's an under-leveraged company. In fact, it's paying a blooming dividend. If it said, well, you know, we're going to change the world and rescue everybody, they're all up in Glasgow talking about saving the world through battery technology. By the way, we're going to cut our dividend and we're going to invest into the future of humanity. The share price would go through the roof, wouldn't it? No, oh no, it's going to cost too much for us to do batteries, which is the future of humanity. Oh no, capital too intensive. Oh no, got to stop it. Going to sell it off to someone. Does anybody want to buy our battery technology? I mean, it's pathetic, isn't it? But anyway, it will probably bounce. Okay. And it will probably bounce because somebody will probably come along and say, oh, what? You sell 15 billion pounds worth of all this environmentally friendly precious metal materials, which are the future of humanity. Oh, and you're at a massive discount. Oh, I think we might buy you.
Okay, that's very interesting. Before we go into Resolute Mining, you mentioned about takeovers, targets. So let's look a few of them. Let me maybe start with Vodafone. I mentioned that in the past.
When you look at these companies that have vast sales and pay fat dividends, and you think, well, if I took their dividend and I use that as an income stream to borrow money, oh look, I could borrow that. I could buy that company for its cash flow. I mean, if I owned it, if I borrowed the money from some happy banker and I bought this business, how long would it take me to pay off the debt from my profits? Well, with Vodafone, the cash flow is gigantic. They're paying out 6% dividend. So, you can borrow money at 3%. So you could borrow the money to buy them at 3%, and then you'd be 3.76% of their market cap up every year. So you could use that to pay down your debt. I mean, there's lots and lots of opportunities out there in the UK market, very large companies, where you could basically be paid to buy them. Yeah, and that is the opportunities that I look at, because if you're in America and you were the major drag is a lot of people in the UK are going to get upset when foreign companies come in and say, oh, you third world country, you're giving away your companies, aren't you? Yeah, we'll have them. And then we'll go, oh no, we're upset now. What are you doing, buying our companies off us? Oh no, national interest. So that is the main drag on these things, because these companies are bargain basement prices. And anybody in the US who's getting, say, 2 times sales or 3 times sales or 5 times sales can come and buy an equivalent company in the UK at half time sales or 1 time sales, and pay for the cost of doing so from the very cash flow that these companies are making. I mean, if you scroll down, you'll see the cash flow of Vodafone. I mean, I'm not sure what it is. There we go. Operating cash flow is 17 billion. Well, that's quite a lot, isn't it?
Yeah.
17 billion. And what's their market cap? Again? Okay, so there you are. Cash flow is half of their market cap. So they've got half of their market cap in cash coming in every year. That it would have been a no-brainer 20 years ago, when they were worth 100 billion and didn't have much in the way of sales. And now they've got all those sales. Anyway, Vodafone is an example. And if you bought Vodafone, you're getting a 6% dividend to sit there and wait for someone to come and buy them, or wait for them to get their act together a bit more. It's not a bad deal, is it?
Exactly. Do you have any other one that we can look? Any other spicy? I mean,
I think that, and it exploded yesterday, ITV. I mean, go to ITV, because let me talk you through that. Okay, so this is a company with the whole world of IP. It's been making television programs since about the time I was born. Yeah. So, it not only makes TV, it's got a huge catalogue of TV, and it's got a gigantic business, which is just announced that it's making its biggest advertising sales in the history of the company. I believe that's what they said yesterday. So if you scroll right down let's have a look at them. So there you are. They're making 2.8. That's their turnover is 2.8 billion. If you go up to their market cap, scroll down a bit. Yeah. So for £5 billion, you could buy them. And if you look at Netflix, I can't remember what they're spending, but they're spending about that on their product every year. So in the world of all these media companies fighting each other to death, so market cap, $286 billion. Yeah, they could buy ATV again from the cash down the back of their sofa. Yeah. And then you've got Amazon trying to compete. You've got Disney trying to compete. You've got a few other people trying to compete. Yeah. In America with huge, I mean, Disney's valuation exploded because of their streaming service, although after post-COVID, they've taken a little bit of a drag of people having to get back to work and make money.
Clem, what's the interest of this US company to invest in UK? I mean, what's the incentive for them?
You're now buying all our product to distribute on your channels, so that's an extra distribution channel, all for 4 billion. Yay! Yeah. I mean, bargain basement stuff. Yeah. Bargain basement. I mean, Disney's worth 316 billion, and ITV, one of the key channels in the UK, is worth peanuts.
Yeah.
So would not be surprising if someone came along and said, oh, we'll have that. And again, of course, you'll have people getting upset, saying, oh, but that's not right. Oh, why? We're giving it away. Well, the UK stock market is what the UK stock market is. Why does it give away it value them? Why is, I mean, you know, the English are famous for looking down their noses at the way that French do business. But there's only one European exchange that's as crippled as the UK exchange, and that's the French exchange. Look at the German exchange, it's through the roof. Yeah. So, you know, there's a systemic problem with the London Stock Exchange and the way that it values British companies. Or there's a systemic problem with Great Britain. And, well, we should maybe one of the same. So it is very, very interesting. Now, some people might say, well, it's all going to sort itself out. And I tend to agree with that. But, you know, the jury's still out on that one. And I know Zach's got something to say if he hasn't got bored with me not shutting up.
I think Zach left. Probably, I think he had a meeting and he was not.
No, he's very, very busy at the moment. He's got some great news apparently out there. So good old Zach. Okay, so let's look at Resolute Mining. Well, you see, I can't really talk about it because I actually hold that. But I mean, if you want to pull up, say, a 5-year chart on these things. Okay. I like to look at things long term rather than short term. Yeah, it is. Well, it's quite depressing, a part of. Well, it's not depressing. It's exciting because, you know, unless they've gone and shot themselves in the foot and have all run off with the loot, it's gone from being an expensive stock to a cheap one. A very cheap one. Yeah, well, maybe it's very cheap. Maybe it's not very cheap. It's also making a nice W bottom as well. So that go to the financials. I'm getting quite good with this. You are getting quite good. You got Amazon though, so it's LSE RSL, I believe. Yeah. You are. Right. So you know it's got so its market cap is 273 million. So let's see what they're selling. So scroll down. More. Right. Okay. So they've actually, you've gone past it. You've gone past the sales. Keep going up. Stop there. Stop. Yeah. Stop. So they're actually making 602 million. That's how much gold they obviously, or whatever they're up to, they're getting out of the ground. Where are they, Clem? Just to refresh my memory. I have no idea. I see. I don't buy like that. I will go through all the gold companies, and I'll say who's making gold. And well, these guys are making gold. Apparently, 600 million of it. I can't remember my thing of what I did to go through it. But if the gold price goes up, and they're making selling 600 million of gold, and they're losing 6 million doing it. If it goes up by 10%, they're then making 660 million, and they're making 54. Yeah. So the operational leverage of a rising gold price is important. Now, there are things like how much have they pre-sold through hedging? You know, have they got any huge problems going on? So you have to read their news. But then you don't go, I like this one, I'm going to buy all of it. You go, well, have a little bit of that. And then you say, well, who else is out there? Oh, sentiment. CUR. Yeah. One. How much they're producing? Here we are, 830. Right. Yeah, that's quite attractive as well. The eye of Steffi has gone, oh, she moved in my window. She's back. Here we are. Sentiment. Yeah, you froze. So sentiment, excellent. Well, look at this company. It's in Egypt. It's got a market cap of 1.1 billion or 1.2 billion. It's paying a % dividend. Yeah. I like them. I mean, people laugh at dividends, but you know, you sit there being not right or not wrong, and 6% just lands on your doormat. So you get paid just to sit there and you know, think you're right or hope you're not wrong. And even if you're wrong by 6%, you're no worse off. So if you scroll down to their sales, 800. Yeah, so look at that. Love that chart. I love that chart. You know, when it's going through the roof, I hate that. You know, because I might be making money, I might be being proved right, but the higher it goes, the closer it gets to the moment when it stops going up. Yeah. So if you go back to sales, which is down a little bit, so people might think that's strange. I mean, you say it's depressing. Stop. hold the bus. Right. So, wow, look at that profit margin. So it digs up 800 million in gold, which is, so its sales is a little bit more than the gold it digs up. It makes 300 million doing it. That's a lot of money. So of its 1.2 market cap, that's a 4 PE. You could buy the company and its profits in 4 years. Wow. That is cheap. A 14 PE is market normal. 12, 13, 14, 15, 16. That's the area where companies that people think are great, that's where their PE is. So if suddenly everybody thought sentiment was great and gold was the thing, it could potentially go up 4 or 5 times. Now, again, you look at that, you say, well, it might be something great might have happened. They might have, had a meteorite of gold land on their head and made an extraordinary profit. But if you look back, you see that the year before they dug up 600 million in gold, 650, and made 173. So you can see it's all in line. And the year before that, 600 and 150. And the year before that, they did 200 million on 650. So when the gold price went up, their profits went up. So if gold goes up, their profits will go up yet further. So at some point, people will go, well, I need gold. Well, I don't want to buy gold coins because they're difficult. I don't want to buy gold futures because they're dangerous. I don't want to buy a gold ETF because that's too dull.
Yeah.
I want to buy something a bit spicy. So I want to buy a big, boring gold miner like Newmont Mining. I want to buy something that's a little bit spicy, like Centamin. And I want to buy something really, really spicy, like Resolute.
Yeah.
I'll buy a big chunk of Newmont or somebody like that, or gold or Barrick if you like them. I'm not a big fan, but some people are. I'll buy a big chunk of that. I'll buy a big chunk of the American ETF, which is I'm buying solid gold in an ETF form. So I'll buy a big chunk of that. I'll buy a nice chunk of a big miner. I'll buy a smaller chunk of something a little bit frothy, and then I'll buy an even smaller amount of something that's wildly crazy. And if I find something utterly insane, I'll have some of that too, just a tiny little poke.
Clem,
and then you've got a diversified portfolio.
One question, we see they've got more, they don't have almost any credit, they've got very small credit, the rest is all equity. Wouldn't it be better for them to get, to get credit? So if I'm looking at the
well, you can borrow all the money you like, but you can't dig up more gold with credit, can you? You've got a gold mine, you dig in the hole as fast as possible, and once you're digging it as fast as possible, there's nothing to be done apart from give out your cash and keep digging.
Yeah, exactly. Okay, got it.
And it also means that the company is very sound, which is good, because if you're digging up gold in Africa, you need a little bit more of a belt and braces attitude to life, because the risk profile is significantly higher than if it was a gold mine in the UK. Interestingly enough, you can't really buy gold mining in a sensible place. You can buy it in Australia, you can buy it in North America and Canada. But once you get outside of that, you've got geopolitical risk to take into account, which is one of the reasons these things are relatively cheap, because people start to break out in a sweat if it's in Tashkhanistan or in the wilds of Siberia or whatever. And that is a risk, and risks are what gets you paid sometimes.
Clem, I have got a question. Now we are putting crypto in the mix. So if we have, obviously using inflation hedge strategy, like buying gold, we talk about gold mines, or buy crypto, why you would buy gold instead of buying Bitcoin, right? As an inflation hedge. Bitcoin has also the volatility, has got the upside, is considered as an inflation hedge. Because so why buying gold? Is to diversify the portfolio? Why you just don't buy gold and go full feet into Bitcoin? Because
it's not a hedge.
Okay.
It's like it's a trifid, not a hedge. The idea of a hedge is that it lowers your risk. Yeah. So you've got this inflation coming, and inflation goes up. So you've got something that reacts in a way that neutralizes that movement. Bitcoin doesn't neutralize that movement at all. It's the worst possible thing for a hedge. It's the sort of thing you want to hedge. It's not a hedge.
Yeah, that's
because
a good point.
because you know, if I bought at 60,000 earlier on in this year, I saw my money halve, and I've seen that I've got it all back now. I mean, no, that's no hedge. That's a roller coaster. You don't. It's like you know, yeah, it's not a hedge. It's a highly volatile, very interesting new asset. It ain't no hedge. I mean, you could use it as a hedge if you were, you know, a quant, and you could work out what tiny proportion of your portfolio you should have in an exploding asset like Bitcoin. But it's not like, you know, say, well, I've got a hedge against inflation. I bought, you know, 27 kilos of gold. That is more what people complain about with gold, and I complain about it too, is that it's so turgid. Is that it is so, you know, numb. And that is what a hedge does for you. It numbs your portfolio. It means it, rather than going like that, it goes like that. Yeah, which is why institutions do it, because, you know, they want to go home at 5 and they want to get in at 9:30. They don't want any wildly swinging stuff. They don't want to really get up at 8:01 just to make sure they've still got a job. That's why they hedge stuff, because they want to say, oh, we've had a good run. Let's just cap it there. Yeah. So the rest of the year we can go on holiday because we've made our 7% that everyone hopes we're going to make, and we're going to hedge it so that it's not going to move now. So hedge is taking out the sort of volatility that Bitcoin is by its very nature. So, you know, you can hedge Bitcoin in all sorts of ways if you wanted to, but it in itself, if you wanted to use that as part of a hedge, you'd have to use a tiny part of it, because the beta of Bitcoin is just gigantic. So it's not the place to go for a hedge on anything. It's the place to go for an undiversified, one-directional punt on something. And whether that punt is it going to the moon, or that punt is it to go into the floor, that's really the only mainstream use for something like Bitcoin as a protection against inflation for your assets. I mean, that's mad. Yeah. It's like saying I'm going to protect myself from being scratched by this cat by jumping out of a 5th floor window.
I think this is a great point, because what the media is kind of communicating as main message is Bitcoin as inflation hedge, and they keep comparing it to gold, with actually there are more nuance, and it's not so, you know, it's not like they say, and it's important to discuss that.
The gold isn't just an inflation hedge. It's a haven asset. So when the proverbial hits the fan, you want to be in gold up to an extent. I mean, you know, that's the old idea. And, you know, and people are maximalist about that. You know, if there's a war, you need gold. Well, actually, that's not necessarily true, because as people found out in the Second World War, they would swap gold for cigarettes. Yeah. And soap. But, you know, generally speaking, when you want to get your money safe, gold is a good place to put it in, because it's a haven. Now, that part of what gold is has, to an extent, been superseded by Bitcoin. Because if I was a corrupt Afghanistan government official wanting to leg it out of Kabul with $10 million, I wouldn't have to leave it on the tarmac like somebody did $5 million of cash on the tarmac when they were skedaddling out of Kabul, because I got it on my little smart stick. In fact, it's already gone. It's on the blockchain. I bought Bitcoin, you know, when it looked like it was getting a bit sticky, and now I can just, I can walk naked onto the airplane and fly off, because it's on the blockchain. And you can't do that with gold. I mean, gold is $80,000 a kilo. So 20 kilos is, you know, $1 million. Well, if you're an Afghan, I was once sat in Dubai in the office of a real estate agent, and he had all these apartments were being sold, and he had all these paperwork kind of stacked on his desk, and there was all these interesting names that I recognized from places in Africa, for example. And there were multiple $1 million properties that these people were buying. You know, they were all obviously honest politicians who spoke for the people, but it seemed to have quite a few millions to stash in Dubai in property. You can't get out on the airplane with that amount of money in gold. The airplane would never be able to take off. Bitcoin, not a problem. So for those eventualities, like if you were a Chinese real estate mogul, you don't want gold, you want Bitcoin, which is probably why they banned it there. If you are leaving Kabul in a hurry, you want it in Bitcoin, etc. So the place that gold has had for that flight asset, that has been diminished. But the counter argument is, for every person that you see that's got a computer, a phone that says Bitcoin is, who needs gold? There's 25 people with no computer, with no mobile phone. Well, maybe not 25, no mobile phone these days, that love gold. The whole of the developing world loves gold. Yeah. They cover themselves in it if they get the opportunity. And Bitcoin, although if you're super sophisticated and you've got a Mac and you've got an Apple phone over there and you're in the top tier 1% of people, you might say, oh, I don't want gold, I want Bitcoin. But everybody else down there, I mean, take India, a huge consumer of gold for saving purposes. They love gold, and I'm sure they like Bitcoin too. But most people don't have access to the technology that facilitates Bitcoin, and most people with money are too blooming old to want to wrap their brain around it. Exactly. So the role of gold in the world, which is a $7 trillion asset, as opposed to crypto, which is a $2 trillion asset, is going to go on and on and on. Because ultimately, what is good for jeans is good for Levi's. Yeah. And what's good for Levi's is good for jeans. And what's good for hard assets is good for Bitcoin and gold. And gold is just slow, sluggish tortoise, and crypto is the hare. Well, who's going to win that race? Probably both of them, frankly.
Yeah, I think that was a great a reflection, I think, on the role of gold and Bitcoin. I mean, he also highlights a strategy in case we are seeing any kind of political tension, and there might be a moment where we should look Bitcoin more closely, because obviously if people have to move country, as you said, even if they don't like Bitcoin, they might are forced to do it. And so then Bitcoin can have a rise on the back of that. So kind of political tension, they can be.
I think you're totally right. But I think you have to think the following thought. What made Bitcoin go from 30,000 to 60?
Institutional buy?
There's big trouble in China right now.
Yeah, and China, yeah, exactly.
There's a lot of people in China. There's a lot of money in China. And if you were managing a pop band of a load of rather fashionable young men, I might want my money in Bitcoin. If I was a superstar actress who was about to make it to be disappeared, I might want my money in Bitcoin. If I was a Bitcoin miner, I might want my money in Bitcoin. If I was a mogul for the collapsing property Goliaths that are out there that are all having deep trouble because of Evergrande, I might want a few 100 million of my assets in Bitcoin. If I was a computer game company that had just been told not to sell my product to young children apart from on a Saturday, I might want my money in Bitcoin. And so the list goes on. There's a country going through a social revolution, a quiet one, social clampdown, not very quiet one. And, a lot of people with a lot of money are going to think, I don't think I want to run to the airport with a bag of gold. Maybe I need to get hold of some of that Bitcoin stuff.
Yeah, it's very interesting what is happening in China.
And up goes the price at 1 a.m, by the way. If you want to look at Bitcoin's price, when it goes through the roof, it's often just after midnight when the Asian markets open. And funny enough, when the markets open in the UK, or when people's offices open in the UK, down goes the price. So maybe someone's buying Bitcoin in Asia. I wonder who that would be. And then selling it in London. So the money's in London, not in Asia, or in America, not in Asia. Yeah.
What about the weekend strategy? Is still there a strategy where crypto prices or Bitcoin prices goes up over the weekend, or?
Well, it's a private investor strategy. And I think if you go and look at Google Trends, you'll notice that the search for Bitcoin on Google by the private investor is not what it used to be. So, and again, when people spot these things, they soon die because people trade them away. Because if you think it's going to go up on a weekend, you buy on Friday, don't you?
Exactly, and you sell on Monday.
And it goes up on Friday. Well, no, you sell on Saturday when the people come in and push it up. So you buy on Friday, you sell on Saturday because it's going to go up on Saturday. So now it doesn't go up on Saturday. Or it doesn't go up so much. It goes up on Friday because everyone's buying on Friday to sell on Saturday because they think everyone's going to be buying on Saturday. So they buy on Friday. So the price now goes up on Friday.
And now,
and then people notice it always goes up on Friday. So they buy on Thursday, and then it goes up on Thursday, and then it doesn't go up on. And that's the way markets work.
Yeah, interesting. Okay, Clem, thank you so much for sharing all these interesting insight. And just to remind everybody interested in hearing more about ADVFN final result, ADVFN strategy, I want to remind everyone that there is an event in 1 hour and a half on the London Stock Exchange platform, where Clem is going to be again live.
I'm going to dress up.
Exactly, talking about the great result that ADVFN announced yesterday. And I think it will be a great opportunity for anybody to join, listen, but, you know, not just to understand the ADVFN story, but also to understand ADVFN as a product, as a platform, what is offering, because people like myself, I learn to invest using ADVFN, having those tools that you work yourself out to to get better information, to get better parameters, rather than listening rumors of friends or bloggers, because at the end of the day, you have to do your own due diligence. So, I couldn't do without ADVFN. So everybody should check it out. Okay, that's me done. Clem, thank you so much. And I will see you next week for the usual market smart investing with Zach.